if you're a Canadian retiree or you're about to retire, what I'm going to share with you in the next few minutes could put an extra $50 to $80 in your pocket every single month with the latest February 2026 payment cycle. But here's the problem. Thousands of seniors across Canada have no idea how these pension increases actually work. And if you don't understand exactly how the numbers add up, you might not realize you're already receiving more money, or you could miss out on benefits that are rightfully yours. So stay with me until the end of this video because I'm going to break down exactly what's changing, who's getting the increase, how the $50 to $80 figure is calculated, and most importantly, what you need to do to make sure you're receiving every dollar you're entitled to. Let me start by addressing the elephant in the room. You're probably wondering where this $50 to $80 monthly increase comes from, and I'm going to give you the exact breakdown right now because transparency matters. This isn't a single new payment or a one-time benefit. This is the combined effect of multiple increases that have been implemented to help Canadian seniors keep up with the rising cost of living. And when you add them all together, many retirees are indeed seeing their total monthly income from government benefits increase by $50 to $80 or even more compared to what they were receiving last year. Here's how the math actually works. If you're 75 years old or older, you're receiving a 10% enhancement to your old age security pension. This enhancement was introduced in July 2022 and it's permanent. It means that if a senior aged 65 to 74 receives the maximum OAS of around $698 per month, someone 75 or older receives approximately $768. That 10% enhancement alone is worth about $70 per month extra compared to what younger seniors receive. But that's not all. On top of this 10% age-based enhancement, all OAS pensions are indexed to inflation every quarter. The indexation rate is based on the Consumer Price Index, and for 2026, we're seeing cost of living adjustments in the range of 2 to 2.6%. Let me show you what this means in real dollars. If you were receiving $700 per month in OAS last year, a 2.6% increase adds approximately $18 per month. If you're 75 or older and receiving that enhanced rate of $768, the same 2.6% indexation adds about $20 per month. Now let's add the Canada Pension Plan into this calculation because most retirees receive both CPP and OAS. The average CPP retirement pension after the January 2026 indexation is now approximately $840 per month. This is a significant increase from previous years due to both the annual cost of living adjustments and the fact that newer retirees have generally contributed more to CPP throughout their working careers. CPP is indexed annually to inflation. With a 2.6% increase applied in January, someone receiving the current average CPP would see an additional $22 per month compared to what they were receiving last year. Here's where we get to that $50 to $80 range I mentioned. Let's take a real example. Imagine you're a 76-year-old retiree. Last year, you were receiving $740 in old age security and $820 in Canada Pension Plan for a total of $1,560 per month. This year, with the cost of living adjustment of approximately 2.6% applied to both programs, your OAS increases by about $19 and your CPP increases by about $21. That's $40 right there, just from the indexation. But remember, you're also receiving that 10% OAS enhancement because you're over 75. If you just turned 75 recently, or if there were any processing delays in implementing your enhancement when you first became eligible, you might now be receiving the full enhanced amount, which compared to the base rate is about $70 higher. When you combine the age-based enhancement with the annual indexation, you can absolutely see your monthly government pension income increase by $50 to $80 compared to what you were receiving before. There's another scenario where seniors see increases in this range, and it involves the Guaranteed Income Supplement. GIS is income tested, which means the amount you receive depends on your annual income from the previous year. If your income has decreased, perhaps because you stopped working, because you're taking less from your RRSPs, or because you had a one-time income spike last year that's now gone, your GIS entitlement can increase significantly For low-income seniors, GIS can provide up to approximately $1,065 per month for a single person. Even a modest increase in GIS eligibility, combined with the regular CPP and OAS indexation, can easily result in $50 to $80 more per month in your total benefit income. Let me give you another specific example to make this crystal clear. Maria is 77 years old and receives Old Age Security Canada Pension Plan and a partial guaranteed income supplement because she has some modest RRSP income. Last year, Maria received $720 in OAS because of the 75 plus enhancement, $800 in CPP, and $200 in GIS, for a total of $1,720 per month. This year, the cost of living adjustment increased her OAS by approximately $19 and her CPP by about $21. Her GIS also increased by about $15 based on updated income thresholds. Maria is now receiving $1,775 per month, which is $55 more than last year. This is a real, tangible increase that makes a difference in her ability to pay for groceries, medications, and other essential expenses. Now, I need to talk about something that affects higher income seniors, and this is critically important if your annual income is approaching or exceeding $95,323. This is the Old Age Security Recovery Tax threshold, commonly known as the OAS clawback. If your net world income on line 23,600 of your tax return exceeds this amount, you'll have to repay some or all of your old age security pension. For every dollar your income exceeds $95,323, you must repay 15 cents of your OAS until it's completely clawed back at an income level of approximately $154,000. Here's why this matters for the pension increase discussion. If you're receiving employment income, RRSP, or RRIF withdrawals, rental income, or other sources that push you close to this threshold, you need to be strategic about your income planning. The 2.6% OAS increase might put more money in your account initially, but if it pushes your total annual income over the clawback threshold, you could end up having to repay some of that increase when you file your taxes. This doesn't mean you shouldn't take the OAS. It just means you need to be aware of the clawback and plan accordingly. There are strategies to minimize or avoid the OAS clawback. Income splitting with your spouse can keep both of you below the threshold. Contributing to an RRSP, if you're still eligible, can reduce your taxable income. Carefully timing large RRSP or RRIF withdrawals or capital gains to spread them over multiple years can help you stay below the limit. If you're in this higher income bracket, it's worth consulting with a tax professional or financial planner to develop a strategy that maximizes your benefits while minimizing clawbacks and taxes. For most seniors watching this video, the clawback won't apply because the threshold of $95,323 is relatively high. But if you have a generous workplace pension, significant investment income, or you're still working part-time with a good salary, you need to be aware of this. The difference between careful income planning and not paying attention can be thousands of dollars per year in lost OAS benefits. Now, I need to be completely honest with you about something important. Not every senior will see a $50 to $80 increase. The amount of increase you personally receive depends on several factors, including your age, your total income, which programs you're enrolled in, and your specific circumstances. If you're under 75 and have a moderate to high income that makes you ineligible for GIS, your increase will be smaller, likely in the $20 to $40 range from CPP and OAS indexation alone. If you're over 75 and receiving the enhanced OAS, your increase will be on the higher end of the spectrum. The key point I want you to understand is that these increases are not hypothetical, they're not rumors, and they're not something you need to apply for separately. They happen automatically as part of the normal indexation and enhancement provisions built into Canada's pension system. However, and this is crucial, you will only receive the full amount you're entitled to if Service Canada has accurate information about your income and your circumstances, and that information comes from your annual tax return. This brings me to the single most important action item from this entire video. You must file your income tax return every single year, even if you had little or no income, even if you don't think you owe any tax, and even if you believe you don't need to file. Your tax return is how Service Canada calculates your guaranteed income supplement, your GST, HST credit, and numerous provincial benefits. If you don't file, you're almost certainly leaving money on the table. I've seen cases where seniors were missing out on hundreds of dollars per month in GIS simply because they hadn't filed a tax return in several years. As soon as they filed their returns, their GIS was recalculated and they started receiving significantly more money, often with retroactive payments covering the missed amounts. Let me address the specific timing question because I know many of you are wondering when you'll see these increases. The Canada Pension Plan indexation happens every January, so the January 2026 increase has already been applied to CPP payments. If you compare your CPP payment from December 2025 to your payment in January 2026, you should already see the increase reflected. Canada Pension Plan payments are deposited near the end of each month, typically around the 27th or 28th, so your January CPP with the new rate would have been deposited in late January. Old age security and guaranteed income supplement increases also take effect in January, but these programs are indexed quarterly, which means there can be additional small adjustments in April, July, and October if the consumer price index changes significantly. OAS and GIS payments are typically deposited around the 27th or 28th of the month prior to the month you're being paid for. This means your February OAS and GIS payment would be deposited in late January, your March payment in late February, and so on. If you haven't seen an increase in your payments, or if the increase seems smaller than you expected, there are several possible reasons. First, check whether you've filed your most recent tax return. If Service Canada doesn't have your current income information, they can't accurately calculate your GIS, and you might be receiving less than you're entitled to. Second, verify that Service Canada has your correct banking information for direct deposit. If there are issues with your direct deposit setup, it can cause delays in receiving your payments or corrections. Third, review your payment stubs or log into your My Service Canada account online to see the exact breakdown of what you're receiving and why. Every payment comes with details showing your OAS amount, your GIS amount if applicable, and any deductions such as income tax if you've requested it be withheld. If you're subject to the OAS recovery tax, you'll also see this reflected in your payment stub. If something doesn't look right, don't wait and hope it fixes itself. Contact Service Canada immediately because pension errors can take months to correct, and the sooner you flag a problem, the sooner it can be resolved and any missing money can be paid to you retroactively. I also want to address a common source of confusion about retroactive payments. Sometimes seniors will see a larger than usual deposit in their account, and they're not sure why. This often happens when Service Canada processes a correction to your file. For example, if you recently filed a tax return showing lower income than previously reported, your GIS might be recalculated retroactively, and you'll receive a lump sum payment covering the additional GIS you should have received in previous months. These retroactive payments can be several hundred or even several $1,000s, depending on how far back the correction goes. This is another reason why the $50 to $80 figure can manifest in different ways for different people. Now let's talk about maximizing your benefits, because there are strategies you can use to ensure you're getting every dollar you're entitled to. If you're still working part-time while receiving CPP, you might not realize that you're building up post-retirement benefits. Every year you work and contribute to CPP after you start receiving your CPP retirement pension, Service Canada calculates a post-retirement benefit based on those contributions and automatically adds it to your monthly CPP payment the following year. Over time, these can add up to a meaningful increase in your pension. The current average CPP of $840 reflects the fact that many recipients are benefiting from these post-retirement benefits accumulated over several years. If you have a spouse or common law partner, pension income splitting can be a powerful tool to reduce your overall tax burden and potentially increase your GIS eligibility. Up to 50% of eligible pension income can be allocated to your spouse for tax purposes, which can bring both of you into lower tax brackets and reduce or eliminate clawbacks on income-tested benefits. This is especially important if one spouse has income approaching the $95,000 OAS clawback threshold. By splitting pension income, you might keep both spouses below the threshold and preserve the full OAS benefit for both. This requires both of you to file tax returns and complete the pension income splitting election, but the savings can be substantial. For those of you who cared for young children while working, the child rearing provision in CPP can increase your pension by dropping out the lower earning years when you were caring for children under age 7. This provision isn't applied automatically. You need to request it from Service Canada, and many seniors, particularly women who took time out of the workforce, are missing out on this benefit simply because they don't know it exists. If you had children and you took time off work or worked reduced hours to care for them, contact Service Canada and ask them to review your CPP calculation with the child rearing provision applied. This could increase your monthly CPP payment, and when combined with the annual indexation, could contribute to that $50 to $80 monthly increase. I need to take a moment to warn you about scams, because whenever there's news about pension increases, scammers become extremely active. You may receive phone calls, text messages, or emails claiming to be from Service Canada and telling you that you need to verify your information, pay a processing fee, or click a link to claim your increased pension. These are all scams. Service Canada will never contact you out of the blue asking for your social insurance number, your banking details, or your personal information. They will never threaten you with benefit suspension if you don't act immediately, and they will never ask you to pay money to receive a benefit increase. If you receive any suspicious communication, do not engage with it. Do not click links, do not call phone numbers provided in the message, and do not provide any information. Instead, contact Service Canada directly using the phone number on their official website or on official correspondence you've received from them in the past. You can also visit a Service Canada office in person if you want to verify whether any communication you received was legitimate. Protecting your personal information and your financial security is just as important as maximizing your benefits. In conclusion, the $50 to $80 monthly increase is real for many Canadian seniors, and it comes from the combination of the 10% OAS enhancement for those 75 and older, the annual cost of living adjustments of 2 to 2.6% applied to both CPP and OAS, potential increases in GIS for those whose income has decreased, and the cumulative effect of post-retirement benefits for those who continue working. The current average CPP of $840 per month reflects these ongoing improvements to the pension system. Your specific increase depends on your age, your income, and which programs you're enrolled in, but the key to receiving everything you're entitled to is filing your tax return every year, keeping your information current with Service Canada, and understanding how these programs work. If you're a higher income senior, pay attention to the OAS clawback threshold of $95,323 and plan your income strategically to minimize unnecessary benefit loss. Don't leave money on the table because of a lack of information. Check your My Service Canada account, review your payments, and if you have questions or concerns, reach out to Service Canada for clarification. This is your money, earned through a lifetime of contributions, and you deserve to receive every dollar you're entitled to in your retirement years.